Welcome to the Explainer. Today we're going to break down how aspiring pro traders can level up their game using two of the most popular indicators out there, the RSI and the MACD. We're going to move past the basic signals and really show you how to start reading the market like a seasoned professional.
So why is it that pros seem to see signals that amateurs just completely miss? It's a great question, right? And the answer? Well, it might surprise you. It's not about having secret, magical tools. It's about using the exact same tools you use, but with a much deeper understanding, looking for the context, not just the obvious signal.
All right, let's kick things off with our first indicator, the Relative Strength Index, or RSI. We're going to blow past the textbook's definition and get right into how pros actually use this thing to get a read on the market's mind.
So at its heart, the RSI is basically a momentum meter. It's just telling you how fast and how far prices have moved. Now, most traders know the basics. You use it to spot potentially overbought or oversold conditions. But honestly, that's just scratching the surface.
And this slide right here, this is huge. It really highlights the critical difference in thinking. An amateur sees the RSI pop above 70 and immediately thinks, oh my gosh, I gotta sell. But a pro sees that sustained high number as a sign of a really powerful uptrend. They know that a strong market can stay overbought for a very, very long time.
So here it is, the pro tip, and this one's a game changer. The high probability signal isn't when the RSI goes into the overbought or oversold zone. No, it's when it leaves. A pro waits for confirmation. They wait for the RSI to cross back down below 70 or back up above 30. That's the real sign that momentum is actually starting to shift.
But the most powerful signal the RSI can give you, the one the pros are always looking for, it's something called divergence. This is what happens when the price on your chart and the RSI indicator are telling you two completely different stories. It's like the price is screaming, "We're going to the moon," but the RSI is whispering, "I think we're running out of gas."
And here are the two main flavors. You've got bullish divergence. Price hits a new low, but the RSI doesn't. It makes a higher low. That tells you the sellers are getting exhausted. Then you've got the opposite, bearish divergence. Price hits a new high, but the RSI makes a lower high. That's a huge warning sign that the buyers are running out of steam. You got to think of divergence as your early warning system that a trend might be about to turn.
All right, let's move on to our second tool, the Moving Average Convergence Divergence, or MACD. Let's see how this builds on that professional approach we've been talking about.
Now, I know the MACD can look a little intimidating with all its lines and bars, but really it's just three parts working together. You've got the fast MACD line showing you short-term momentum. You've got the slower signal line, and then you have the histogram. And all the histogram does is show you the distance between those two lines. That's where you can really see if momentum is speeding up or slowing down.
You know, amateurs, they just wait for those two lines to cross. But a pro is watching that histogram like a hawk. When those bars on the histogram start to shrink, it's a huge visual clue that momentum is fading, and it often happens before the lines even think about crossing. It's like hearing the tires squeal just before you see the car stop. And guess what? That same powerful concept of divergence applies here too. When the price is pushing up to new highs, but the peaks on the MACD histogram are getting smaller and smaller, that's a massive red flag. The market is basically telling you that the strength behind that move is disappearing.
Okay, so this brings us to what is probably the single most important idea in this entire explainer. Professional traders don't trade on single signals. They build a case. They hunt for confirmation. In a word, they look for confluence. Confluence is the secret sauce. It's the art of finding several different non-related signals that are all pointing in the same direction. This is how you filter out all the market noise and dramatically crank up the probability of your trades working out. So just picture this with me. Imagine the price is coming down to a major support level on the chart. That's signal number one. At the same time, you look down and you spot a nice bullish divergence on your RSI, signal 2. Then you glance over at your MACD and what do you see? A fresh bullish crossover. And the histogram bars are starting to grow. That's 3 and 4. See? Any one of those is kind of interesting. But all of them together, that's a powerful, high-confidence case for a trade.
Look, knowing these strategies is half the battle, for sure. But what truly separates the pros from everybody else is actively avoiding the common mistakes that just blow up most traders' accounts. This is all about discipline. It's all about mindset. So let's be crystal clear about these traps.
First, never, ever trade an indicator by itself. Price action is king. Second, stop trying to trade off super short time frames. Most of the signals there are just random noise. Third, and we've already hit this one hard, don't just blindly short every time the RSI goes overbought in a ripping uptrend. And finally, you have to remember, these indicators are lagging. They tell you what has happened, not what will happen. They aren't a crystal ball.
So we'll end on this thought. You can learn every pattern and every signal in the book, but the real key, the thing that takes you to a professional level, is having the patience and the discipline to just sit there and wait for these high-quality, high-confluence setups to come to you. The chart will give you the signals. The real question is, do you have the discipline to wait for the right ones? That part is all on you.